we
ask.
turn into the deep end in the moment.
Between Justin and I, we know everything anyway, so you ask, we'll answer.
You know, it just seems like the last panel I had. It seems like you guys you're ready for the.
It's
you
like
guys are all.
I think it's my
talking to each other
7th
before.
Zoom of the day or something ridiculous like that. So.
Andrew,
wow.
I was pleased to see your name in the mix when I got looped into this.
Well, you can thank Johnny for that, right? So Johnny said you were the qualified person, so here you are. All right, so it is now 3:30 in the afternoon. Thank you, everyone, and welcome to the KoreSummit Webinar Series 2021. My name is Oscar Joffrey, and welcome. Obviously, you can hear it. We're having some fun here with our two panelists that I didn't know they knew each other. Now that we do, you know, those are welcome to leave. But I encourage you to stay because it's going to be a 1 hour of fun, 45 minutes of straight talk conversation. That's right. No PowerPoint presentations, no plugging in product naming, you know, here's an iPhone, buy it now. None of that. And of course, 15 minutes of questions and answers for you that you can ask the panelists. And of course, like always, all our events are on YouTube Live, and of course, they can be made available to you on our Core Connects channel, so you wish to watch it before. So today's discussion is an interesting one because I think, you know, it's one that I am certain each of you have been asked tremendously, and I'm going to ask it from different ways because that's the advantage I have, is ask it to. So the topic today we're going to have is, how do I know if my company can use Regulation CF? But before we get there, let's do some quick introductions. And let's start with you, Justin. You're the new kid in the block. So you're on.
My name is Justin. I lead business development and operations at WeFunder, which is an equity crowdfunding platform. My job is to find awesome entrepreneurs that are looking to raise capital and help them figure out how to construct their raise on the platform. My background, I started at a nonprofit called Kiva, which does interest-free crowdfunded microloans. I built and established the US program at Kiva, and then moved to San Diego and started my own boat business, which I operate. It's called Chill Charters. I joined the WeFunder team about 2 years ago, and I just love working in the startup world. It's a true joy connecting with founders and helping them figure out how they can raise capital. It's an important part of the equation, and if I can add value, that's my main goal.
Great, nice to meet you. And Mr. Korn.
Hi, everyone. I'm Andrew Korn. I'm the founder and CEO of E5A. We are a systematic, data-driven investor acquisition firm. I got my start writing IPO roadshows for major investment banks and have worked on hundreds of them and thousands of aftermarket presentations, meaning for analysts or brokers. I eventually built that firm to around 80 people, sold it, eventually did 2 stints as chief marketing officer at 2 public companies, and left and changed careers to asset management, built a multi-factor model, built a bunch of ETFs and some other financial products, sold that firm, and started E5A. E5A has been around for about 5 years. We work marketing financial products, mostly in asset management, and then got involved first with Reg D, then Reg A+, and we're recently CF, since CF is going to 5 million on March 15. The odds of March.
You took away the only thing I had to add to this whole conversation.
Sorry.
You took away my opening.
Hold on. Forget I said that, and let's do a little drum roll for Oscar.
Yeah, we'll do a little rewind.
All right, I got to get my mind into this now. So yes, of course, thank you. I don't have a background like these 2 individuals, which is that's why they're here, because they've had more experience. So, but the good news, I think Andrew touched on it. Some good news, fantastic news. So on the last webinar we had, people have been hearing about the buzz about a freeze. Well, that freeze is not going to happen. We are going live on the 15th of March. You can raise up to $5 million. That's 1, 2, 3, 4, 5, 1, 2, 3, 4, 5. Okay, $5 million into your company. So nothing is stopping it other than you, and we're going to get started. So, you know, the question, how do I know my company can use Regulation CF? So let's start it from one perspective. I'm gonna guide you guys a little bit, but please feel free to, because you guys see it all. But let's start it geographically, because I think this is an important one. It's one that gets lumped in during discussion, but I'm gonna start it right from the get-go, because, you know, the whole world's watching this saying, holy, I want to go and do Regulation CF. I heard it's pretty simple. So let's start from there. Andrew, geographically, Regulation CF, who's it for and who it's not for?
So let's start off with, I'm not a lawyer, and I'm also not an investment banker. I have played both on the stage, though. So that does make me a little bit qualified. So, you know, the whole thing goes back to the Jobs Act, and the Jobs Act was one of the very few bipartisan things to happen in the U.S. Congress in the last 50, 100 years. So with that, it is all about U.S. companies, or if you are a non-U.S. company, having a U.S. subsidiary that intends on doing business in the United States, because it is all about creating jobs. I think that is reasonably accurate. Oscar,
Okay,
you're more of an authority on this than I am.
Yeah, well, I just want to make sure it's black and white for people when it comes to Regulation CF. It was a regulation under the Jobs Act, which is great, but it's for US-based companies. I know people go, well, you know, I'm from Canada, I'll go out and create a company. From Australia, I'll do that. I caution you all, before you do that, please speak to legal counsel. I'm not trying to put WeFunder. This is not about WeFunder or Andrew and all that. It's about, what is your strategy for capital raising? You may find it that if you do that, you're going to derail your ability to use the really great exemption of Reg A. So there is a trap between Reg CF and Reg A that most people do not understand. And foreign issuers need to understand not to get caught in that trap. So I leave it at that the regulation was intended, and it is for creating US jobs for US companies that are based in the United States. Okay. So
I might add that.
Yeah, go.
I might add that international companies can take advantage of Reg CF in the U.S. if you have an incorporation in the country. So you can be based overseas as long as you have an incorporated kind of arm of the company in the States. I've seen international companies utilize crowdfunding.
Yeah, but then that subsidiary has to be the one raising the money, not the parent company. And
yes.
Then can they rely on the strength and balance sheet and reputation and history of the parent company? It
Right.
starts to get gray.
Right.
Well, and it will go from gray to red the minute they decide, oh my God, I want to do a Reg A, and that's when it gets unraveled.
Sure.
There's a great article that Sarah Hanks wrote that everybody, look, the reason I put it out is because there's a group, I've been watching the ads, and this is obviously an important question because everybody's thinking, hey, it's just I'll incorporate in Wyoming and set up shop and away to go. But again, I'm letting you know that there is a process that the SEC, if you do decide, and I say this again, if you're doing a Reg A, no other exemption will it get exposed as it does in a Reg A. So we've seen it, and it's very sad when the deal just goes right, because the SEC will put a stop to it. So okay, so we kill that bing, one down. Next. Who else can? So all right, so let you started the conversation, Justin, by saying you like working with startups. And then, of course, Andrew, you've been dealing with mature-based companies. So this is going to be a really interesting conversation between the two of you here. So obviously, Andrew, I'll start with you. You're coming new to the Reg CF, but you've known about it. How do you see, or do you see that established companies can use it? Or is it simply, as Justin said, for early-stage startups?
So I'm seeing established companies use it in a few ways. One of them is it's a backdoor way into raising 80 million instead of 75. It's a way of almost testing the waters with a Reg A plus, but actually accepting investments using the CF, because the barriers to a CF are much smaller than they are for a Reg A. The time frame is much more compressed. The costs are way less just to get going. So that's one way I see established companies using it, and others are using it as so let's get into startup. You know, they have an MVP, they have a minimally viable product, or they don't. People call us and they've got a PowerPoint, and most of the time we suggest they go to a platform or even do a friends and family raise before going to a platform. But some companies, they have their minimally viable product. They've got a bunch of doors open. They have a really good plan and path. They've got some reasonable management in place, and they'll come to us for a Reg A. And as of a month or so ago, we'll say, whoa, slow down. It's going to take 4 months just to get the legal done. Why not do a CF? Raise between $1 and $5 million, hit a few milestones, then you're legitimately, you can raise your valuation and then go and do an A plus. So that's another use that I see for CF that I think is really viable. And frankly, we're already working on 3 of those. So that's a way I see CF being used, kind of in the in-betweeners.
Yeah, of course. And Justin, from your end, obviously you started off helping entrepreneurs, so startups. Are you limited to that, or you're love to hear your thoughts on that one?
Yeah, the activity I've seen has been mostly companies in the seed to Series A. In 2020, there were a lot of companies using platforms as a bridging mechanism, bridge rounds to get past COVID and into 2021, where they were going to take a more kind of like focused approach at raising serious capital in a Series A. Obviously, with the regulations going from 1 to 5 million, I think that we will have the capacity to help companies through that Series A. Obviously, depending on the company, depending on the industry, a smaller Series A of 5 million definitely opens the gates to a large extent. But seed stage to Series A, where it's like, hey, we've already raised some capital. Hey, we've got traction, and we're looking to buy time, more or less. That's what I'm seeing on our end.
So so up until recently, nobody, RegCF, we talked about it, but there wasn't a lot of talk. Andrew, you knew that we didn't include it in topics. All of a sudden, it's become a topic, and we got to face that. They call it the white elephant and the pink elephant in the room. It's there it is. And actually, Pittsburgh did a report. What are the effects of RegCF now in the venture capital space? That's pretty impressive in my books, that Pittsburgh now recognizes that this regulation actually is going to compete now head to head on a seed round, on a Series A, with this type of investor base, which I think is exciting from an entrepreneurial point of view, that you have this particular choice. So because of this increase, obviously it's changing the roadmap of what kind of company we see could utilize it. We've been predominantly thinking them as startups only, and that's because it's under $1 million, just startups. But and as you said, that's Justin, bridging. I know that you've been using it, Andrew, for clients who are using it for another capital raise, right, as a stepstone bridging again. But does this game completely change now? We're March 15th today. We're $5 million. What kind of company now can expect to use this that wouldn't have looked at it before, and they should look at it now, Andrew?
So one of the things I think that the audience is getting here is kind of a East Coast view, West Coast view as well. Not that we don't both work everywhere, but having grown up in New York and having started several businesses, and I am not a young entrepreneur, doesn't make me any less of an entrepreneur. And I believe that Justin is one as well. And I know several people on his team, and I would say they're all entrepreneurs working together for a common cause within this industry. So, I said it very quickly before, so maybe I can be a little bit more illustrative. What we are counseling a lot of companies who have done a seed round or they've done a friends and family round is what we generally call it here. It's like raise a little money, get yourself going, prove that there's some real viability in what you're doing, and then come to someone like us to help you raise the 5 million or close to it, meaning, you only need 4, you need 3.5, whatever it is you're going for as a CF. And when you do it as a CF, as we said, minimal paperwork, it's very quick to file, you get approvals very quickly, and then prove yourself. Now you've raised a serious amount of money, kind of like a Series A. Lots of Series A's are not anywhere near 5 million, they're less. Some of them are 5 times that as well. Has to do with industry and stage and, who the backers are and who the management team is. But with $3 million, most concepts can go out and really prove themselves. So if you're raising 3 million and you're starting and saying, hey, my firm is worth $20 million already, which is probably too high, but I'm going to raise 3. So now my post money is, let's make it easier math. I'm at 17 million. I'm going to raise 3. That means my post money is 20. I just sold 15% of my firm. 15% is owned by people outside of my core group or management. Well, that's great. Now you're going to raise 50 million because you proved a lot with a Reg A. Well, now you can raise your valuation to something more appropriate because you don't want to raise 50 when your pre-money valuation is 20 because you're giving up the bulk of your firm. So and that you want to do when Wall Street comes and grabs it, when you do your S1 and do your IPO. So and that was a joke because you never really want to, you always want your valuation to be appropriate. But the CF is a great way of getting in some serious capital, improving your valuation, and then raising more money with an A+. And that is a very typical stepping stone. But frankly, there's other scenarios where I see using CF as well. But that one I'd love to, toss it over to Justin and see what he thinks.
Yeah, Justin. I would love to build on that. I think that what we're seeing now and a new kind of perspective of how to use a platform to help with the raise, I think traditionally it was kind of seen as a one, there's a 3-month window in which you're running a campaign. Now the idea is there's no kind of time limit on a RegCF raise. So you can raise your first $1 million and then you can actually pause your campaign, close out all the investors that came in through that first $1 million, then increase your valuation and cycle back and build over an extended period of time. So the ability and the construction with these new regulations allows for a kind of evergreen, consistent fundraising process that happens in stages until you've kind of, and you can start this process as early as inception, where it's like, hey, first money in, friends and family, and we're just going to build until you've raised that 5 million. And at that point, if you've raised 5 million, you've clearly shown there's demand, there's appetite, people are interested in what you're doing, which can justify the extra cost and time and energy to kind of roll into the Reg A. And to be able to do that and build a base of investors over a prolonged period of time, I think, excuse me, I think is an incredible opportunity for entrepreneurs and will be the status quo if you look at the 2 to 5 year horizon.
and that's pretty valid. I mean, we're all agreeing startups, mature-based companies, companies that are already established. It's becoming clear now that this is it's an equalizer that's bringing everyone in. There's another group that I actually want to bring into this discussion, and I want to hear your thoughts on it. Do you think it will have an impact? Because, you know, $5 million is, you can do a lot as a company, right? You can build a restaurant, you can start a software company, a consulting firm, and all that. So, so I'll go to you first, Andrew. Minorities. I mean, if you know the father of the Jobs Act, David Wield, I mean, his big passion of the Jobs Act was democratizing capital, giving owners back and all the ownership, which is it's clearly doing. But the other was to become an equalizer for minorities, you know, Latinos, Black, people of color, just to bring the equalizer. Do you see the same impact?
So not yet. You know, we tend to work for issuers, not for platforms, but we play very nicely with platforms. But as a client, we're not like interested in building up their investor base. We're interested in ringing the cash register and bringing money in. So the one exception for us is that there is a platform aimed at the Black community, and they want to raise money for you know, Black-owned businesses and then raise it from the community. And my only advice to them is like, let's expand that investor base to supporters of the community. Similar, we're working on a project and it is aimed exclusively at the LGBT community. And that's you know, also an easy community for us to identify. And I want to take a step back because this goes to all CFs. Why does someone want to do a CF rather than friends and family? Well, if they're going to, maybe they've run out of friends and family and they started that way, they've gone through that money. Yeah, but they're on the right trajectory. And I say this about A+, but now I really say it about CF. The reason you want to do this instead of venture capital is you don't want to give up a board seat. You don't want to, and also, do you want your business verified by 3 or 4 people who are highly educated, or do you want thousands of people, many of which are highly educated, to come in and verify your business by investing? So one of the reasons to crowdfund is I want a crowd as my investor base. There's a Reg A+ that Oscar, you and I both know. They already have 30,000 investors. Their goal is to have 1 million investors. And it makes sense in their business. And if they have the right transfer agent, if you know a good transfer agent, please recommend them for us, Oscar. So going back to an equalizer, it is, if you understand data targeting, if you understand the needs of the community from an investment perspective, if you're willing to do some investment education along with it, and I'm very willing to work with this particular platform that's aimed at the Black community. But what we're doing, and it's fascinating how I got into the whole supporter thing, is in this LGBTQ project, we were doing a lot of data. I'm working right now in my dining room, and my daughter heard me and said, "Dad, why are you excluding so many people? What's wrong with you?" And basically I said, "What are you talking about?" She's like, "Well, if you're looking for followers, RuPaul has 12 million. So there are a lot of supporters, and maybe you want to take a look at that data too." And I think every group has supporters. So that is something that's going on. Now it's just awareness, and let's get people in who have viable businesses and definitely make sure that, you know, that all the ducks are in a row to make sure that everyone is successful.
Good point. And Justin, I'll throw it back to you. Obviously, WeFunder, you guys have been successful. Have you seen a trend with minorities? And if you had some examples to give us as well.
Yeah, I would like to make a point before I jump into that is I think it's really powerful, especially for consumer-facing brands. It's like, if you can convert your customers to be investors, they're going to be your best customers. If you can bring in new investors and convert them into customers, you know, it is a two-way flow where it's like, you're building a strong investor base, you're also building a strong customer base, and that can be a really powerful asset for any given company. To transition specifically to the question around minorities and evening the playing field, first, I'd like to flag that WeFunder is a public benefit corporation. If you read our charter at wefunder.com/charter, that is in our very explicit kind of motivation to exist as a company, is to help bridge that divide. The way I look at it is, traditionally in angel investing, you go out and, you're talking to early angels, you might have a $25,000 minimum check size for people to be able to come in and invest. To be able to lower that to $100 really opens a very wide door for people to be able to engage in this capacity. So I think that, being able to activate kind of local communities to fund businesses that they want in their community, I think that's one of the biggest benefits of a platform, is being able to accept people with no minimum to come in and be a part of the action. The best example, and the one that comes to mind, is a raise that we did last year with a business called Black Mama Tea. It's a tea shop in New York City. And they got a media PR kind of shout out through a Black business publication, and raised over $1 million from Black people in New York. That was the circulation, and that was where all the activity came from. A really powerful example of how media and PR can just drive a lot of people in the community to support a common cause. But I think if you look at it more practically, it's like, you take this, this tea shop, it's a physical location in New York City. Anybody that comes in and gets tea or, kind of engages with that business physically has the ability, that the retail shop has the opportunity to extend that to all of their customers, which is a really powerful offering. It's a cool way to engage with their customer base in a meaningful way. Again, going back to my first point around your customers being your investors, that's going to be your best customer. Bringing in new investors, converting them to customers, that's just like a very powerful marketing mechanism that also raises you capital. So if you can knock out two birds with one stone, I see it as a no-brainer personally.
Yeah, both your comments are good, but I think you both missed the point. So being a Latino, an immigrant in a country, it's one thing being born in a country and feeling like you're here. I'm 55 years old. Not all of you guys are younger than me, of course, but I'm an entrepreneur and I feel like 20, but I know what it's like being an immigrant and raising capital. It's I've been very fortunate as an entrepreneur that most people didn't know I was a Latino. As a joke, I kid you not, I came out of the closet in 2001. In 2001, I actually made a news announcement that I was born in Chile. Up until then, most people thought that I was German background. So I got to hear the smirks of, we belong in huts, or the only thing we're good for is mules. And so I firmly believe, though, from my perspective, that minorities have an equalizer. And that's the message that I want to get here. I agree with you. They will, you still need to have all the basics. It's just the fact that you're a minority and, oh, there I am. No, you still need to, but it provides you that ability now. Nobody will judge you that way because you can spread out. More people are somewhat paying attention to it. And what Andrew said is even more critical, is that you can combine all the different subgroups of it because there's attention to it. People are starting to see that just because you are from this culture doesn't mean that you cannot be an entrepreneur. And there are people, mark my word, there are people who have that ingrained in their mind. And that's why I think, when I hear the story of the tea shop, it makes me feel happy because I hope there's another young lady or another young man sitting somewhere wondering, oh my God, I have this idea, but I just didn't want to go for it because, how are people going to think about me running this business? So that's why I think the regulation crowdfunding, well, the Jobs Act, and if you listen to David Weil today, version 2.0, it's all about minorities. He wants to make it more accessible for women. I know, Andrew, you're part of that. You have some daughters yourself. That we all want to make sure that there's an equalizer, and so that's my take on who can use it. I think we'll see more of them this time. I think we will see more minority entrepreneurs, which will be great. I didn't say they're going to be successful. That's not what I said. You still need to have the basics.
Well, so let's get into that and what success is, because Justin brought up a really good point of companies that are consumer facing, and that has been the essence of what's happened with CF in the beginning. But there's 3 or 4 other categories of things in crowdfunding that we see are moving. And yeah, our experience is more with A+ than CF, but as I mentioned, we have CFs going or about to launch, and all of them will then amend their filings to go to 5 million on March 15th. But we're seeing real assets. We're seeing impact investing. We're seeing innovation, and we're seeing things that produce steady income. So there's a lot of different categories. Those are 4 more categories. And I just want to hit back on I don't know anything about the tea shop, so I'm not commenting on the tea shop. Let's call it a dry cleaning business. You have a dry cleaning business and you want to open 3 or 4 more stores. Absolutely, RegCF is a way to go. You've got customers, you want to expand into more neighborhoods, etc. It's still a lifestyle business. So now we're getting into expectations. I put money into a startup and I'm hoping it's the next Google and I'm going to get 10,000 times my money back. That's one expectation. And that's more the venture capital mindset of I want 100 or 1,000 times on some of the investments. And I should diversify and invest in a bunch of CFs so that one of them will end up hitting. But there are a lot of CFs out there where you're just going to invest in the dry cleaner who's expanding and they're going to share in their profits. And that is a really great thing to do to help small businesses. And I think CF is fabulous for that not everyone has to be shooting for the stars.
Great point. Great point, Andrew. Thank you for that. Because I have to remember, going back a few years, the whole idea of it, you don't need to be a unicorn to be successful. There are different levels of success. And that it's funny you mentioned the dry cleaner shop. That was the story we always told, how important is that dry cleaner to you that's just around the corner from your house where you drop off your items, right?
Well, I live in a small town called New York City. I live in Manhattan's Greenwich Village. So it is so small townish where I live, I don't even get a ticket. I drop my clothes, we chat for a couple of seconds, now both in masks, and I leave. I don't get a ticket. They charge my credit card and send it to my doorman. Like, we know each other really well. Why would I put them through that? So yeah, they are part of the heart of the community. So here's the difference is I can't work for that client. They can go to a platform and they can use all the services of a WeFunder and have a successful raise. But a company like mine is going to say no to them. We're only looking for the ones that are swinging for the fences. Why? Because we're a marketing company. We're an investor acquisition firm. We are not a platform. So on top of us, you're going to have to pay a platform. And their platforms are from very inexpensive to more expensive, depending upon what they offer. Justin can certainly speak to that better than I can. But we are built to raise a lot of money. So if someone wants to raise $600,000 for store expansion, we are not a viable option for them because our fixed costs are going to be too high for a raise like that, where they can go onto a CF platform, and I'll kind of hand this ball off and let you take that.
Yeah, I honestly want to double down on my point earlier about the minimum investment size. Having a $25,000 scope versus a $100 scope, opening the door from a minority standpoint, I think it adds a lot of opportunity. Obviously, from the community example, the local dry cleaner or the local cafe, that's one use case. But I think this use case applies across all businesses, where if you can open the door without, it's like, how many people in your community have 25,000 of disposable income that they can put in an investment? How many people have $100? That is an equalizing effect that is very powerful. So I think that that ability to offer equity and to offer something at a lower dollar amount, it helps even the playing field.
It does.
Perfect.
It does.
It does.
But some are shooting for the stars, and they're only $100 minimum investment. And I go back to this entertainment company. They want 1 million shareholders because when they put a new movie out, if a quarter of them go to that movie and bring a friend, they have their first 500,000 people. So
exactly,
the minimum dollar amount doesn't always equate to what the goal of the company is. But I totally agree that if you keep it low enough, you're going to get a lot of passion people who just want to be a part of something. And that's a really good thing. And that goes a lot to positioning and messaging and what people think of what you're doing and what it means to their future. If they're even thinking it through that much, they may just look at it, say, gee, I love it. We actually turned down a solar project because it was a small solar project. They went up on WeFunder, and I'm one of their investors.
Yeah.
Even though I said no to them, that our firm can't help them. But that doesn't mean I don't believe in what they're doing, and I was very proud to make that investment. So
I appreciate the passion investment. I believe in that as a construct in the scope of what we do. But I also think that it's like you can make a smaller investment because that's what you can afford to do, and be looking for those bigger, those 10x plus opportunities. Just because you invest $1,000 doesn't necessarily mean it's a passion investment. It could mean I'm interested in investing. I see a lot of opportunity here, and I want to, that's what I can afford to invest. So I do think again, it's there's a lot of use cases here. But I don't necessarily think that just because you invest $1,000 means it's it's a pity play or a community play or a passion play. It can also just be an investment play from somebody that doesn't have $25,000.
Yeah, and it should be a sound investment. Even $100, you should do it not only to help, but because you believe you're going to get a return.
For sure.
Yeah. That is one of the big questions. So we have a new client we're onboarding. They take cow manure from major dairy farms, capture the methane, and turn it into almost zero emissions jet fuel. So they are cleaning up what is basically toxic waste coming out of dairy farms, and they're turning it into something that we need that is polluting the world, but they're doing it where it barely pollutes the world. So we've got two things going on there.
Right.
We're going to need jet for a very long time. They're not going to all be electric in 5 years. And anyway, so is it consumer facing? Kind of, because everyone knows what dairy is and everyone knows what jet fuel is. Is it passion? It kind of is. Also, they have a zero cost on their raw material, which is the methane coming from cow manure. So is it passion? Is it a great investment? I think it's a little of all of those. Yeah. So this will be a $50 million raise. So it's an A+, not a CF, but it could have started as a CF easily.
Yeah.
Yeah, to get the engine started. But where I want to circle the conversation to, we've talked, we're determining whether your company qualifies, and we said, okay, you're US based, you're either startup or you're already operational, you're consumer based, non-consumer based. So you can get the idea that right now it's basically A to Z. Everything's up for grabs. But there is one part that I think that isn't always up for grabs, and we get to see it always afterwards. And this is a question that doesn't get asked up front or doesn't get dealt with up front, but it needs to be. And that is, there's a lot of entrepreneurs that love it. They go, oh yeah, look at this, I can raise $5,000, excellent. I'm going to be able to stick them in that SPV, put 10,000 people there. I'm ready to go. But it isn't. The other part of the qualifier, in my view, is that the company needs to qualify itself and its operational side. How are you going to manage that base, not just from a shareholder perspective, but what else are you going to do? Because if you just treat it like a shareholder base, we're not going to be any different than public companies. Oh, I'll just report to them every quarter and I'll get back to them. It's going to fail. So I think part of the qualification is, okay, great. Are you ready for it? Because part of the Jobs Act was, you got the ownership back. Now the responsibility is on you. What are you going to do to keep that shareholder happy? What do you think of that, Andrew?
Well, you are building a community, whether you like it or not, because if you have $100 minimum investment, and let's say your mean average at the end is 200, and you've raised $2 million, you now have 10,000 investors. So with 10,000 investors, how are you going to manage them? You need really good technology, but also you need really good communications, because if 1% of them decide to call you because you're not communicating, that is a boatload of phone calls that you just don't have time to deal with. So if you have a proactive investor relations plan, then you're going to stay ahead of that. And you can over communicate, but it's pretty rare. Most of the time, you want to not only have your regularly scheduled communications, but it's like, oh, we did a webinar for you to help raise the money. Why not do a webinar for your shareholders and let them know what's going on? It'll get you ready for an investor day when you finally are if you decide one day to go public. So putting out regular and milestone-oriented communications is important. Here's the part that's tough until you do it, which is when there's bad news, you need to do the same thing. You can't just be spreading sunshine. There is no business that doesn't hit bumps in the road, and those need to be shared. And remember, most people who invested in you are there for the journey, not just for the end result. So nothing is going to be a straight line up unless they have crazy expectations.
Thank you for that. And I'm going to come. Sorry, Justin, please.
Yeah, I would just add on. I think good investor relations is self-serving. These are folks that can double down. They can invest more. They're going to buy your product. They're going to be your best customers. If you effectively engage with them, I think it adds a lot of value to the business. So I think it's a very self-serving kind of strategy to build a base of investors and engage with them in a way that they can drive the business forward. I look at it in a very pragmatic sense. This is a powerful stakeholder. With the right engagement, it can add a ton of value to the operation.
I agree 100% with both your comments. So now I'm going to, with me, it's all about data, right?
Bring the heat,
baby. Bring the heat. So with all of that, then why are they not doing it now? And I want the people that are here to listen to this, because this is important. We're growing up. We're having lots of great success with online investing, and we want it to be even more successful. We don't want the SEC to shut it off. But personally, I'm getting concerned. I'm getting concerned because I see companies with 5,000, 2,000, 1,000, 10,000, 100,000, and I can pinpoint the companies that are communicating daily versus the companies that are not. And we see it. People go, I heard from them all the time when they were raising money. Now I can't get a hold of anyone. So I believe that the education that needs to start, it needs to start whether it's at WeFunder or the Andrew Corns of the world or our world, but we have to. I mean, are you getting that feedback? I mean, obviously at WeFunder, it would affect you, because if investors are not getting information, they would not be investing. So kudos to a certain degree. But I'm also finding out that investors often don't realize that they could actually go back to the WeFunders of the world and file a complaint there while the company's not reporting to them. Like How do you guys feel about that?
I mean, it's, I think it's bad business if you're not communicating with investors. And I think it's our job to articulate why good communication helps your business. So I think that, we to the extent that we can try and translate that. You're obviously going to have companies across the spectrum. We have a lot of companies that are doing it really, really well. There are surely lots of companies that aren't doing it at all. And my best kind of take on that is it's, I see it as WeFunder's job to articulate why it's good business and why it's a good strategy and why it's in their best interest to do that effectively. At the end of the day, it's up to the founder to decide whether that's what they want to do. There are certain SEC regulations and pieces in place that require updates, but I think that from my perspective,
it's funny you mentioned that one. So it's funny you mentioned that one. So again, we're not going to dwell on the past. The past we learned, we got to do it. And to your point, you've got to put that in position. But more importantly, you have regulatory reporting. This time the regulators are not going to give a pass. I firmly believe, as many do, that this time. So the consequences are that, again, you're coming in. Do you qualify? Are you ready for this regulation? You've been handed the gift to raise money from the crowd, 233 million Americans. So are you ready? You fundamentally, as Justin and Andrew said, having an investor relations person, that could be the CEO. I mean, it doesn't change anything. Just being regular about it, maybe once a month, maybe every 2 weeks. The same way you go after clients. I'm sure you're communicating with them daily. So why would you not do it with them? But that regulatory reporting, if you miss it this time, I firmly believe that they will remove that 12G rule, which puts you in a predicament you do not want to be in, which is you're a full reporting issuer, just like a publicly traded company, and nobody wants that. So this is where
I mean, let's just go back to the basics. You've decided to take in outside capital. Yeah. That makes every single one of them is a part owner of your company. It's just a simple thing. So do you talk to your partners? Well, these are passive partners. They're not active in your business. But if you had one single investor and they were a venture capitalist, they're going to make you do a quarterly board meeting, do a board book. They might even make you do monthly meetings and hold your feet to the fire. So here you have this very supportive gang of people that's your gang. And, if, I'm kind of forced to do the Sun Tzu quote of all battles are won or lost before they're fought. If you plan properly and every month I'm going to put out a note, some of them are going to be 3 sentences and some of them are going to be 3 pages and everything in between. That all works because then you're authentic. You're telling them what's going on. And it doesn't have to be monthly. It can be based on events plus quarterly. But whatever it is, plan to do it. It needs to be part of your communications. And every time I hear, I'm just too busy for that, it just means that you're not prioritizing your shareholders. You're prioritizing revenue above shareholders, when you were prioritizing raising capital above revenue. So, you can't just shift that back and say, now you're in the back seat, so I can go do this. It's like, yeah, but we're in the back seat and we're watching what you're doing.
Sorry, go on.
No, I was just going to say, but they don't truly know unless you tell them. And
I like your analogy.
It's just simple. Tell them. It's really simple.
Yeah, I was going to say, it's also not like a huge ask to do like a quarterly update on what's happening with the business associated with a webinar. Like we're talking about like maybe 2 hours a quarter of like baseline engagement that is best practice. I don't think this is like terribly complex. Every quarter you say, this is what's going well. This is not what's going well. This is how you can help the business. We're doing a webinar on Friday from 3 to 4 to talk about the business if you want to join. Like putting that together is, that's a poor excuse if you can't make that happen.
Or as simple as you're not licking. You don't have to lick 5,000 envelopes and make 5,000 copies and stuff them and get 5,000 stamps. All you have to do is write the email. You send it to someone on Oscar's team and say, send this to all my shareholders.
Right.
And it goes out. It's just not that hard.
It's easy as 1, 2, 3. You know, this discussion has been good. You kind of got a grasp. Obviously, we have some attendees. This is your time now to ask questions. You may be curious. Does your company qualify? The company, all you need to do is click raise hands if you have questions, and we'll be more than happy to answer the questions here with Andrew and Justin. We will continue, obviously, the dialogue here until I see somebody's hand is up and asking the question. But the reason I'm spending a little bit more time on this one is because, you know, Andrew's brought up the point that we're always going to find people, the scoundrels of the market, where they're going to take advantage of something so simple, file a Form C and raise my capital and I'm gone. We need to flush them out. And I'm flushing them out pretty quickly. I often go, are you ready to manage 10,000 people? Why do I need to manage 10,000? I'm going to put them on that SPV. Yes, but you're managing the SPV. The way the regulators wrote the rule is that you're still responsible. The only thing that they gave you is the ability to put one line item on your cap table, but you're still fully responsible for all the holders in this company. Oh, nobody wants that. I thought the whole idea was I could put them on the SPV, get the money, and operate the business. And that is the red flag right there, right? That is, I ran into a couple companies that is their use of the SPV, to stick the investors in it so they don't have to do it. They feel like it's going to be taken care of. And I often say, so who do you think takes care of that? Well, the SPV. You're the SPV. It's a constant. So I'm all for, you know, any company utilizing it. Come in with your eyes open, trying to understand the dynamics of valuation and what's best for the market and for you and all that. But as well, okay, what are your plans after you raise the money? Because you're going to be successful. What's the plan here? Because they both need to be part of this whole strategy. I know why we started this way, but we now have enough data to say it's time to change. And that's what I'm telling the both of you. I can tell you unequivocally in RegCF, more than 98% of them do not do this part after they're done. And we need to fix that, because now that the regulators have given us the gift, we now need to take it to the next stage. And I don't believe the regulators this time around are going to sit back. $1 million was different. 5 brings it up to another level. And we're also introducing something different that we hadn't seen before. And I'm surprised you didn't touch on it there, Andrew. That is, there's the refunders of the world that are going to assist you, but the broker dealers are getting into this. So who will be held accountable to what if things don't go?
Let me just touch on that for 2 seconds. So we now have the green light with the next CF that we're doing, where we are building an offering page the same way we would for an A+. It will be on a unique URL. It won't be, but it will then be hosted by the broker dealer, so that fulfills the RegCF obligation. And their fees are substantially lower because they're providing fewer services than what a WeFunder would. So no more CMS, everything is 100% customizable, but this is what it takes to raise $5 million as opposed to $1 million. It is exponential. It is not as simple as we're going to do this 5 times, because you're going to run into a data wall where there are just no more investors. You know, we will identify millions and millions and millions. My firm has a proprietary database of 1 million angel investors. That means they're all accredited. That's not enough to do a raise, not even close. It's the tip of an iceberg. But knowing that we have all these new tools, including total customization, this is going to make a really big difference. This is also, though, it then kind of weeds out who can do this because they have to be able to afford our services and afford all that custom work. So for a ton of issuers, when I speak to them, I'm like, hey, do you guys know WeFunder? Do you know some of the other platforms? This is really where you belong based on the size of your raise and what your current capabilities are when it comes to financial resources. So
that's an interesting dynamic we never touched on, that it has in itself, the fact that we changed it to 5 million, the issuer themselves has now changed the playing field. We've added another element of, we brought in different types of funding portals, revenue-based, revenue sharing, equity, different verticals, vegetarian, arts and all that. But this is very different, right? A broker-dealer actually now doing RegCF, recognizing, to our point that I started this whole conversation, that, hey, wait a minute, I didn't want to touch it when it was 1 million, but now I'm touching it because it's 5. And now my Reg D client is an actual RegCF client. Would that be correct or no?
Yeah, I mean, the mindset has been that let's build a website and every deal will follow a certain pattern because it makes it easy for investors. And I totally agree with that, to, raise $1 million, but raising 5, I love that we will have the freedom to do anything we want and set it up so exclusively for that issuer. And it is a completely different world. And I'm curious what the platforms are going to do and how they're going to react to that. And there may not be a ton they can do until the 15th of March. I'm not sure about that. But, we are already in the midst of getting these set up so that we can start off with $1 million and then, of course, amend the raise on the 15th to 5. And be set up and have already built the data and built the messaging and done a lot of the optimization work that we do to make it so that it can scale. So we're super looking forward to all of that because it is a game changer for issuers.
Yeah, clearly. Obviously, Justin, it's just new. You're probably not sure if you were catching wind of that, what's happening.
No, I mean, we have a full-time person at WeFunder that thinks about this all day. So it's very much top of mind. Like, if our investors aren't being treated right by the founders, that hurts our business. So it's in our best interest to make sure founders are doing right by the investors that they get. And in terms of these different kind of channel partners that are going to come into the mix, it'll be interesting to see how it develops. I think that it's going to be, the industry is going to evolve a lot over the next year.
No, I agree. I think this year we're going to see some really interesting things. In our earlier channel webinar, we just heard that the very first Reg A deal raising $50 million actually had a institutional investor that took a fairly large chunk of that. So we're already seeing an introduction of different types of investors coming in too. And I think now with RegCF, another thing that we didn't touch on, but we've spoken about it before, is that the accredited investor can now invest. I mean, that's an unlimited amount. There's no limits anymore for them as they had before. So if I'm an accredited, I'm thinking, why not invest here? I don't need to go through that whole verification process that I'm like, people say, well, we should be putting more effort in reducing the regulation, the accredited investor exemption, who qualifies as that? And I go, yeah, you can beat that box. I know we've been going at it for the last 3-4 years. It's gotten us nowhere. But on the other hand, they're expanding year by year or every 2 years the ability to do more with what we have. And I just have to think to myself, what more do the regulators need to provide us?
Yeah, the only Reg Ds we work on now are either institutional, or we've gotten it, whatever the project is a QSIP on some custodial platforms so we can market it to independent financial advisors. But CF and A take care of all that. And just like we have 3 $5 million CFs, We already have two $75 million Reg A pluses that we're starting work on. So the industry is expanding where it should, and quality issuers are seeing this and saying, wow, this is a whole new way of raising money for ourselves. And that does not make it so startups can't do their work. You know, we've got a blockchain company that basically is doing vineyard to table. You know, it's all about wine. Like there's so much innovation out there. It's unbelievable. And there's some great quality issuers, but of all different sizes.
And that's the key, right? It's no longer before it was just these sizes. Now we've expanded that now even greater. And I think that's the closing remarks, is that for Regulation CF, the market has been open March 15th, and the conversation starts now. You obviously you need to have your proper partners, your legal advisor, your financial advisors, of course, working with firms or a platform to guide you in that journey, whatever's in best. But more importantly, we've expanded the type of companies that can now take advantage of this regulation, see it as a really great way to fund their operations or their business or their dreams. But regardless of all that, just try to keep the principles in place why it was created in the first place. Democratization, keeping the ownership back to you, but with a responsibility, as Justin and Andrew kept saying, and I keep repeating over and over again, do not disregard these people. They're critical to the success for all of us. We love the fact that they put in billions and billions of dollars to date, and they are going to keep doing it again and again and again, but we all have to work on it together. So this is what I truly love about RegCF, Reg A. It's a true team sport. It truly is. There is no, you're on it by your own. You're not. You're never going to be alone. That's for sure. You're going to be in a very large crowd. So I want to thank everybody for coming out this wonderful Tuesday afternoon. And hopefully you'll make it to our next webinars tomorrow morning at 11:30 in the morning. And then, of course, at 3:30, we have, almost 2 a day coming with you until the mid-April. We want to bring you the top thought leaders, people like Andrew and Justin, and many more to come. And you'll get an opportunity. If you want to get in contact with them, you can go to www.KoreSummit, KoreSummit.io. Oh, Jesus.
.io or .com?
No, .io. .io. And you will see, click under speakers, you'll see his name and his contact details, email address, full transparent, so you can get a hold of them and start engaging. Thank you again, everyone. Justin, thank you. Andrew, as always, have a great afternoon, everyone.